Hi there. Let's take a closer look at the income and expenditure statement. If you remember, income and expenditure is one of a trio of reports that help you run your business more effectively. So, looking at the example income and expenditure report, we've got sales of 45,000 and we have cost of sales of 30,000. One thing to note is that the cost of sales figure isn't the same as the goods that you purchased during the month, because some of those goods you won't have sold. They'll still be lying in stock. So when you're working out the cost of sales for the sales figure in a month, it's the cost of the goods that relate to the sales that were made, which is not the same as the goods that you purchased during the month. So some things that you purchase will go into stock and they may lie there for a while. So the time of purchase does not relate necessarily to the time of sale. So that's one thing to note, that you have to match up the cost of sales to the actual sales that you made during the month. And you'll see that after deducting your cost of sales, you've made a gross profit of £15,000. Now, gross profit can be affected by a number of items, and this is where having a close eye on what's happening is really important to manage the bottom line profit in your business. For example, if you expect to make 33% because you've bought something and you've marked it up in order to make that margin, that's fine in theory. But if, for example, you decide to give away a discount when you're selling the item, then you've immediately reduced the gross margin that you expected to make. And equally, the cost of sales that you expect to go against your sales may not always be the figure that comes out in the final analysis. For example, if you had to send a member of staff out to fix a job that wasn't done properly, then that becomes an added cost of sale that you didn't expect, and it will reduce your gross profit even further. So you can begin to see that the way your business acts and manages customers can have an impact on the profitability that you make, because profit can be leaking away, and sometimes it's not always apparent that this is happening until it's too late. So having good reporting at this level and understanding all the mix of elements that make up your gross profit and being able to control and manage it is a very important factor in maximising your profitability. So now we have overheads, and the thing to note about overheads in your income and expenditure statement, this is the monthly cost of each of these items. That's not the same as the cash that you've paid out for those items. And take an example of rent. In this month we're saying that the rent cost for the business is £1,500, and that will be your monthly rental, but you may only pay the rent every 3 months. So when you do your income and expenditure statement, all your overheads are the cost per month to your business, irrespective of when you actually pay the amounts out in cash or from your bank account. So that's an important point to note when you're actually compiling your income and expenditure statement, or when you're using it from your accounting system. So you'll see then that we have now made a net profit before tax of £2,900, which is the gross profit less the total overheads. One more thing I'd like you just to note at this point, that overheads can be split into two categories. You have fixed costs, and these are costs which will stay the same for your business whether sales go up or down, or whether the activity in your business goes up or down. And a good example of that would be rent. If you have a fixed monthly rent, then it doesn't really matter how much you sell, or in fact how little you sell, you still have the same monthly rent. The second category of cost are variable costs, And these are costs that will go up as your sales or activity goes up, and they will also come down as your sales or activity comes down. A good example of this is if you were in a mail order business, then your packaging costs will rise as your sales rise because you're having to send out more product. But at least if your sales drop, your packaging costs will also drop. So understanding how fixed and variable costs affect your business is quite important, and it's something we'll come back to later in the monthly plans as we work through the program. But just to give you an example, if we take the profit and loss figure as that we were just looking at, if we looked at each one, wages and salaries would be a mix of fixed and variable, because some people in the business may be on a monthly salary and they get that payment regardless of what happens. In fact, regardless of how hard they work or how much activity comes through the business, they get paid the same amount. But you might also have a variable element. If you were in a manufacturing business and you were paying for each item produced as piecework, then the wages would go up and down depending on how much you produced. If you run a retail business and you have part-time staff who are on flexible hours, when things are quiet, you wouldn't call them in. If things are busy, you might pull them in more often. So that becomes a variable cost that you can manage to control as activity goes up and down. Rent is usually fixed. Heat and light is variable depending on activity. Marketing is variable, and that's also a discretionary cost because you can decide whether to spend it each month or not to spend it. Telephones are variable depending on activity, particularly if your business is based a lot on telephone selling, then it will vary very much with the sales of your business. So at this point, I just would like you to note the difference between these costs, because when we come to managing your business towards a better profit, how we manage costs between these two categories is quite important. And sometimes it's possible to move a cost from being fixed to variable, or in fact the other way around if it's more advantageous for your business. So the next step is to have a look at the detailed video on understanding your cash flow, and this one is really important because this is where many businesses struggle in managing their bank overdraft and their cash